Hi, this is jeng, and today we're going to be talking about the number one skill of an investor. And I want to start with this quote from Naval Ravikant, who's an angel investor. He said, "Judgment is the work you do before a deal arrives so that your subconscious can process it quickly." So we're going to talk about things that you have to evaluate before investing in a deal, the number one skill of an investor, how to build that skill. I'm going to talk about some of the deals that I've invested in, and then how to get access to deals, access to capital. All right, so let's get started. So, whenever I get sent a deal, the question that comes across is, should I invest in this deal? And I laid out five things here that we're going to talk about when evaluating a deal. So, number one, people. Number two, property. Number three, timing. Number four, market. And number five, the underwriting of the deal. And so let's start with people, right? So, a lot of people ask, should I bet on first-time investors? Should I go with an experienced sponsor? Where should I start, right? And sorry, flipping back to this chart real quick. Warren Buffett said, I want to work with people who have high energy, high intelligence, high integrity. So that's sort of the baseline, the foundation. And then once you find that, should you bet on a first-time or an experienced investor? And we've looked at this base case of $21.5 million deal, 15% equity on previous case studies, and you got to about a 70% return. But if an experienced sponsor comes in and they want a higher equity override, let's say 30% equity override, so double, what does that do to your return as a passive, right? So it goes from 70% down to 53%, and essentially you have to you're going to get about a 17% lower return. So like we had this model here. Here we go. So this was originally 6%. And so on that 21.5 with a 15% equity override, you were at this 69.9%, which is sort of your base case, right? But let's say an experienced owner comes in and they want 30% of your deal. That drops your 53 down to 53%, right? But let's say somebody new is working on this deal and they're saying, look, I'll only take 10% equity override on this deal in terms of my sponsor comp, right? And so your return goes up to 75%. And so what I wanted to compare actually on this slide was, all right, from a first-time equity perspective, you're at 10% equity, you're getting 75%, and the new first-time investor equity owner, he only has to sell the deal for 25 million, right? But then to achieve that same return, that experienced investor at 30% equity would have to sell the deal for 27 million, right? So 8% higher. So let's just see that. So 30% comp here, and then I used 5.5 to get to about the same return. So about that 77% total return just to get to the same return as the first-time passive. So to me, the first-time sponsor, their ability to learn, adapt, their previous prior business experience is going to help me get comfortable on that first-time investor. But whereas an experienced sponsor, they're going to have the focus, they're going to have the team to execute this plan better, and I'm counting on them to achieve this higher return of 27 million. Number two thing that you're evaluating is property. So if you agree, all right, multifamily is the right property type. Next is Class A, B, and C. And you can see historically, Class A vacancies have been lower historically for a number of reasons. Number one is the savings rate is higher on Class A properties. The income is higher. Typically, you're not constrained by people's income on Class A properties, and they just have a little bit more cushion, right, if they lose their job or anything like that. So their vacancy historically has been lower. Class C has come down dramatically in the last, I would say, starting in 2016, it dropped below that just because I think of the rents that have increased, but then also just the lack of affordable housing. And so that's going to have to play into your determination of what class you want to play in. And you can see back in the economic downturn, those people who lost their jobs were hit dramatically and their vacancies came up quite high. I was sort of on the Class C. I would say Class B sits right in between these two lines. Next that you're going to think about is timing. And when you invest in a deal, you have to look at, all right, where are we sort of in the economic investment cycle? So you can see down here in the bottom left, in terms of 05, 06, 07, you can see that sort of once we hit 08, 09, the deal volume dropped significantly, and it was harder. It was just harder to do a deal, right? So Lehman collapsed, all those things in the great Great Recession, 9, 10, 11. It took 3 or 4 years to come back in terms of volume. And then also if you look at sort of price per unit, 2007 all the way to 2012 was pretty flat. And then from 2012 to 2020, it really ramped up. So when you're looking at, all right, when should I come in? When should I be buying these deals? Here are a couple examples that I pulled just from DFW. If you bought sort of late 07, it's here in this time frame on this chart, and then you sold in 2012, you didn't make a ton of money, right? So it went from 29 a door to 35 a door. But then the guy who bought in 2012 and then sold in 15, he went from 6.7 to 10.4. So that was a big increase in the price per door. And then from 15 to 17, held it for 2 years. I think this was around the $12 million purchase based on the loan amount. And so they made an increase as well. And then let's go to this other one. So 2010, right? This person bought it at 17 a door in 2010, and then by 2016, it sold for close to 54 a door. And then from 2016 all the way to 2019, it sold for 20 a door. For 20 million, which is 100 a door, so almost doubled in price. And so, when you're looking at the timing of these deals, if you think you're going to be sitting here sort of 08 to 2012 and there's not going to be a ton of movement, you're going to have to be willing to stick around and hold these deals. And not until we saw really this 2013 to 2020 sort of run up is where a lot of the profit has been made. So understanding the timing of deals. And then market, right? So, DFW is a primary market, but, some people play in secondary, tertiary, you have to decide that. But then even within that market, drilling down into submarkets, right? So you can see where the office is concentrated. Let's say in DFW, I just pulled this chart from Yardi, and where your property sits and where the demand drivers are going to be, right? So how are people going to get to work? Whether your workers are in office buildings or retail centers, you're gonna have to do this for each of your different properties and figure out sort of where those niches are and those submarkets. And then underwriting, right? So you're gonna have to look at the underwriting of, one of the videos we did before was like, what is your number one impact on your underwriting? And it's typically cap rate, right? So what are you gonna underwrite as your cap rate? And do you think it's going up or down? And so here's just some, the spread between the 10-year long-term average versus our 10-year treasury versus cap rates in apartments, right? So in 2006, 2007, there's only 100 basis point spread. So when cap rates are 5%, but 10-year treasury is 4%, there's 100 basis point spread, and people got very nervous, and that's sort of what led to people pulling back. But right now, you're sitting at 10-year treasury at under 1%. Cap rates are probably 5 to 5.5, depending on the market. So there's a spread of close to 477 basis points right now. So you think that's going to go up, down, flat? You have to bake that into your underwriting. And so what does that all come down to, right? So we talked about the people, talked about the market, you talked about the underwriting, the market, the timing, and then the property class, right? So what does that all come down to? And essentially it's judgment, right? So why do people, look to Warren Buffett? Why do people look to some of the top investors in this field? Is judgment around their investment. So how do you build judgment as an investor? And I would say number one is build specific knowledge, right? So when I was at GE, I had sort of general knowledge about commercial real estate, and I did deals nationwide. But now, I work specifically a lot in Texas and see a lot of deals in DFW, and then only in multifamily. And then, so that's building specific knowledge. So how are you building specific knowledge for the asset type, for the, the market that you want to be in? Number two, what is your inside information, right? So I, as a mortgage broker, see a lot of transactions, right? And have completed a lot of transactions. So I talk to listing brokers a lot. I talk to investors a lot. So all that is building my investor insider information knowledge. And so you have to get into that as well. And then also thinking about, we showed the timing chart and who is the buyer after you, right? So if you buy a deal and it's 500 units and the only person after you is an institutional buyer, you better make sure institutional capital is available, right? And so in Dallas, that's been growing, right? So larger deal size, larger portfolios have sold in Dallas. But let's say, especially when oil hit super low numbers earlier this year, institutional investors were just out of Houston. It didn't matter, what the deal was, they were out of Houston. So understanding who the buyer after you is, right? So if you come in and fix a deal and you had to put a recourse loan on it, now somebody coming in after you, once it's stabilized, can essentially come in and buy it with a Fannie or Freddie loan. And so it's going to be stabilized and it's going to be a lot easier for that person. So that's going to increase the number of buyers and your valuation. So understanding who the buyer is after you. And then do you want to be early in a market, right? So we showed that timing chart around 2008, 2009, 2010. So that's repeating right now. And when do you step into the market and how long do you hold to hit those returns? And then experience, right? So, you don't get better at any of this stuff by just watching me do it. You have to actually underwrite deals. And so that's why I provide the model for you to underwrite deals in your market, right? So you have to get out there, you have to start underwriting, and then you have to start investing. Because, Robert Kiyosaki says, once you put money on the line, you learn very quickly. Next question is, who else is investing in the deal, right? So proven investors versus new investors. So who are you surrounded by in that deal? So the general partner, obviously, it needs to be the smartest guy in the room to some extent because they're going to be running the ship. But who else is investing in that deal with you is going to tell a lot. And then, as you're building your judgment, asking others with good judgment about your weaknesses, right? So when I was first starting, I talked to other general partners. I talked to people who had done 20, 30, 40, 50 LP investments in multifamily and asked them for their advice. And I also talked to general partners and asked them what they're seeing. And so asking other people about what sort of holes are in your resume and your experience can help. And then, as the LP, you're not running the company. You're not running the investment. You're betting on the founder. And, Warren Buffett said, buy a business that's doing so well in India can run it because sooner or later one will. And so, it is important for the property, it is important for the person that you're going to invest in, but you never know, that might change, right? And so make sure that you buy companies so good that our property so good that it can run by itself, essentially. And like I said, you're not going to become a great investor by reading about it. You have to go to the source on these deals. And so, I might read a few CNBC articles and Bloomberg articles, but you have to go that next level deeper into the detail, whether that's market reports by listing brokers, maybe that's talking with property managers. You have to sort of be on the ground on these details, because that is going to be a lot more beneficial for you. And then build a network of smart people in the field so they can validate the deals, right? So if you have a question about a deal in Texas, send it to me and I can look at it and tell you, all right, is this a reasonable assumption on these different items? And is that a reasonable exit price? Is that a reasonable cap rate? Those types of things. So start building that network of smart people for your market. And then, the best investors are immune to fear of missing out, right? So, Naval puts together he says he has a 24-hour cooling off period because a lot of times, you get that email from that general partner and they're like, all right, we're going to open this up tomorrow. And, the first 50 people that hit my email inbox, you're in the deal. And so a general partner's put a lot of pressure on you to invest in deals right away. And, it's good to get a good feel, get a good gut feel on the deal, but maybe you don't need necessarily 24 hours, but a cooling off period for your deals. And some characteristics of people with good judgment. They're well-read. They think critically. I like this one. So holding a broad range of ideas and opinions, including conflicting ones. And, Naval says strong opinions loosely held. And so what that means is you need, Robert Kiyosaki says the same thing, right? So you need to be able to see, sit on the edge of the coin and see the both sides of the coin. You have to be humble, low ego. Don't get attached to early decisions, right? And so a lot of times when general partners make a mistake or need to change direction, need to pivot, you have to be flexible, and you're constantly questioning yourself. You have to have some sort of training, some technical training, and be able to deal with feedback throughout the whole way. And this last point, someone with good judgment is non-consensus right. And so what that means is essentially they're right when everybody else is wrong. Because if you are consensus right, typically it is too late and there is not enough return. But if you are non-consensus right, that is where the greatest return comes in. So here, and I've talked about this before, is sort of my high-level investment philosophy around timing, around markets, around property, really investing passive cash flow, looking for GDP growth, no yield curve inversion, looking for 8% on an amortizing basis, 15% IRR. Most of my deals are stabilized deals, consistent collections. So I'm not trying to hit grand slams like the VC game, but really trying to focus in on passive cash flow and making sure that I get a return on my principal before return of my principal before return on my principal. And then primary markets. And then, when I look at GPs, I really like experienced GPs. They have good asset management. They're investing cash in the deal. They're close to the deal. They're local. And they have plenty of liquidity to support these deals in terms of expenses and debt service. And so I want to show you a couple of deals that I've invested in and sort of, rough IRRs of where they have come in sort of to the LP. So, on the Class A side, anywhere from 15 to 25% IRRs over the last couple deals. On the B side, 20 to 30%. And then the C side, north of 30% IRRs. I mean, obviously, this has been a great market to invest in. And, on the A side, whenever you invest on the A side, usually the return is going to be a little bit lower. So you have to be willing to accept that for less volatility. And then the B and C side, all of those deals were sort of stabilized deals. They came in, put $3,000 to $5,000 a door, and then raised the rents and then sold their properties. So average about 27% IRR across those 6 deals going full cycle. And then when I look at my portfolio right now across about 20 deals, 6,000 units, majority of them, so let's say 85% are Class A and B, 90% are sort of Fannie, Freddie, stabilized deals, and then two of them are bridge loans right now. So majority of the foundation was set as sort of passive cash flow, and then deals that I thought maybe had a lot more upside. We went in with bridge loans on those types of deals. And so we're working on refinancing those as soon as possible, so we don't have a maturity event here in the near term. And so next is, all right, you can have all the judgment in the world, right? So you can be the best Warren Buffett sitting in your chair, but if you don't have access to deals, it doesn't matter, right? So how do you get access to deals? One is people join investment clubs, right? So there are a ton of them out there. Getting involved with those, you get access, right? Number 2 is, there's podcasts out there, there's conferences out there. So going to those, meeting those, reaching out to those general partners and building relationships that way. Your network of people, right? So my first deal was somebody I worked with at GE. He became a general partner and I met him. I already had known him for 10 years. And then, so it was very easy for me to get into his first deal. Become an insider. So as a mortgage broker, obviously I meet a lot of general partners, and there's going to be some that you want to work with a lot more than others. And so that's going to become your inside information, inside knowledge, and that gives you just a lot more access to deals. So some way become an insider. where you live, right? So I live here in Dallas, and there are a lot of apartments in Dallas Fort Worth, 700,000, 800,000, and so there's a lot of deal flow. And so if you are in a market with a lot of deal flow, then it's perfect. But if you're not, then you probably need to come to those markets that you want to invest in. And then this is interesting to think about is, a lot of the best deals. So how does accepting your investment in the deal help the general partner? Right? So think about it from the Shark Tank point of view, right? So a lot of people go on Shark Tank and they do not, necessarily just go there for the money, right? And so how can the same way that those guys are helping those entrepreneurs grow their company, how does accepting your investment in the deal help the GP, right? So who can you introduce the general partner to? Who can you, what connections do you have to make that deal even better? A lot of people now have content and platforms and anything that you can do to help general partners, maybe raise equity in the future, maybe find deals, anything along those lines will give you access. Connections to other deals or other investors. When you invest in a deal, let's say you invest with a general partner, asking that general partner, hey, are there other general partners you recommend? Or, as you meet other limited partners, who are other general partners they invest with? And then, a lot of times I'll see an email go out from a general partner and they'll say, look, we've already raised half the money, right? And this private equity fund or this large investor is putting in $1 million or $10 million or $5 million. That's a signal, right? And so if you can be that signal for people, that's a huge, people are going to keep sending you deals and keep trying to get you in their deals. And obviously the best way to, get access is you invest in winners, build a brand and say, look, this is what I do. And so that's a signal for general partners. And unfortunately, the better the deal is, like anybody who wants to get in, let's say Elon Musk companies right now, the better the deal, the less access you'll have. And so you can't just call up Elon and ask for, hey, can I be in your next enterprise or company? That this is actually one of the advantages of going with, like, let's say you've seen an entrepreneur who is very successful in their business and now they are doing real estate and you think, this guy has high integrity, high energy. This is going to be a great guy and is super smart. And so you invest in their first deal when they're trying to raise money, it's harder for them. After that guy will never forget you, right? Because you invested them at the beginning and they're always going to let you into your deals. And essentially you have to have a brand, whether a limited partner or a general partner, and it's who you are. This last piece, you have judgment, you have access, but at the end of the day, you need capital to invest, right? So whether that's your W-2, whether that's you're a doctor, lawyer, whether that's a business you start or a business you sell, or your family has a lot of money and now you're the general partner or you're the private equity shop of the family office and you're running the show, you're the chief investment officer, or you raise capital from others. I've seen people where they raise capital from others and they're in charge of putting it to work. Or you could be a part of the founding team, right? So you can be out there, part of the general partnership, finding deals, raising equity, doing the asset management. You can gain equity by doing that. But and the last one is really investing in deals, and you keep reinvesting over and over again. And it's one of the few professions where you can prove until the day you die, and something that you can always do. So this last piece of advice would say, don't invest so much that you'll behave badly when things start getting rough. And essentially, don't invest so much that if you lose the money, you're going to go bananas on this general partner or this person. You should be okay losing that money. And so that's it. Number one skill of investor is judgment. And then once you build that judgment and, you need the access to the deals and you need access to capital. And so a little bit about myself, born and raised in Houston, went to school at UT, commercial underwriter for 8 years, and now been a lender for the last 5 years across close to 1.5 billion in commercial real estate transactions, and then invested in close to 6,000 units across 20 properties in DFW, Austin, and San Antonio. So if you have any questions, definitely subscribe to the YouTube channel, like this video. If you have any deals that you want to review, definitely send me T12, rent roll, offering memorandum. And then, or if you have like an investment package, that's fine. And then we can set up some time to talk, discuss, buying, selling, refinancing your next multifamily transaction. Thanks, guys.